Hi, everybody. It's Stephanie and Mary Thomas again from Thomas and Thomas PC. We are CPAs and state and local tax consultants here in Houston, Texas. Hopefully, you've already seen a couple of our videos. I'm hoping you've seen a couple of our videos. And we wanted to talk about another topic today, odds and ends. But before we do, I just wanted to let everyone know that we appreciate you clicking on the videos. And if you see something you like, please thumb us up. And we would also love for you to subscribe. So today we're going to talk about odds and ends. These are little things that we have noticed during our career as sales tax consultants that a lot of people get kind of wrong, and it's a little bit weird. So go ahead, Mary. What do you want to tell the people?
Okay. This happens a lot. So if you are one of the people that don't have this, that's okay, because you are not by yourself. One of the things I tell people, specifically within the context of collecting sales tax, is you cannot collect sales tax and you should not be filing a return if you do not have an active sales tax account.
Let's say that again. Say it again.
You should not be collecting sales tax, period, if you don't have an active sales tax account in the jurisdiction for which you are collecting the tax.
And Mary, why shouldn't they do that?
Because you have no way to give the money to the state.
Yes,
so
you don't.
So if you're collecting sales tax for Arizona and you only have an active sales tax account in Texas, and you tell your Arizona client, or you have it on the invoice, that you have collected Arizona sales tax, you have committed a fraud, because you don't have the ability to give Arizona the money. So I always tell people, if you don't necessarily have to collect Arizona's tax if you don't have nexus there, and that's another video. If you don't have any duty to register there, then don't register there. Don't tell your Arizona client that you're charging Arizona tax, because you're not. And the instance in which you would charge that tax, just very quick rundown. If you're in Texas and you get something over the internet, somebody calls you up and says, hey, I want you to send me some gaskets to my Arizona location, and they have no locations in Texas. They got nothing here at all. Then what you're going to do is you're going to sell them the gaskets. Don't charge them any sales or use tax. They're not in Texas. They have no outlets here. They have no touches here. That's it. When they get the gaskets in Arizona, that's their responsibility to report and remit the use tax to Arizona, because that's where they're using those gaskets.
The other point is, as it relates to that, is you're a Texas company, you're sending these gaskets to your customer in Arizona. You're sending it via common carrier, UPS, USPS, FedEx. You're not sending it with your truck. So you do not have nexus in Arizona. You're just a simple Texas company. So you have no nexus in Arizona. You are not permitted to collect any of Arizona's taxes at all.
And you have no duty to register.
Exactly.
And that's very important to say this. You have to have no duty to register. So that means you have no physical or economic nexus. That's another video. But those are the two things that you have to think about. The difference, there is a difference. If that person came to Texas and bought it from your store and then immediately drove to Arizona, you collect Texas sales tax. Sales here. So you would collect the Texas sales tax because they came here and they got it. And then what they did after that is none of your business.
So the big takeaway is, if you are not registered to collect the jurisdiction's tax, you shouldn't be collecting that jurisdiction's tax.
Exactly. And there are some states that impose a duty on you to put on your invoices that whatever they're buying may be subject to use tax. That's by jurisdiction. So that's something that you would have to look up if you have a lot of sales going somewhere. But the big takeaway from this was, and we kind of went down a rabbit hole a little bit, the big takeaway is, if you don't have an active sales tax account, then you're not filing returns, you can't remit money, you're off the radar, period. In Texas, that's an 11-digit number.
What's another odd then that you've been finding?
It is people who don't have sales. You register somewhere, but business drops off and you don't have any sales in that jurisdiction for a period. There are sometimes people don't file a return because they have nothing to report. Some states, including Texas, want a zero return. They want you to tell them that you didn't have any sales here. Don't miss that deadline, because there are people who will not have anything to report in tax, but they have penalties to pay because they didn't file the zero return. So in every jurisdiction in which you're registered, you need to know, do I need to file a zero return if I don't have any sales here? Some states, they don't want to hear from you. If you don't have any money to report, they're like, bye. Other states, they want you to declare the zero. Know what those states are and have some kind of particular system. And there's great software packages that will tell you. And some states are really good about having a system. Everything is filed electronically. They will send you messages that will tell you your return is due. And that is just, I think that is just wonderful that they have systems that are locked like that. They're locked and loaded that'll tell you when they should be hearing from you.
But don't count on that, because not every jurisdiction has it. It is incumbent upon you to understand what your responsibilities are. You can't push that off to someone else and say, well, you didn't send me a reminder.
No.
They don't care about that.
No. And I know that with Texas, what they do is I think everybody has it memorialized, that it's not their responsibility. But some states are just really more automated than others. Another thing that I've seen recently has been people will inflate their sales figures by including sales tax in the sales figure.
That's cray-cray.
Don't ever do that.
That's crazy.
Don't ever do that. If you made $200,000 worth of sales, that's your money, and you collected. We like nice.
We like nice round numbers. We just throw a number out there.
And 10% of that is sales tax, and it's $2,000. No, it's not. It's $20,000.
That's right.
Oh God, what am I doing? And you collected $20,000 in sales tax. Don't report as your total sales $220,000. You have inflated your sales. That $20,000 is not your money. That's the state's money. So what you report in your total sales figure is going to be the $200,000. And then what will happen is, depending on if you'll calculate down so that your returns show that you owe the state the $20,000 that you collected. You give them that money. And that's nice and simple and clean. Don't ever include any kind of sales tax in your sales figure, because it's just you inflating your sales number. And if you do that, they're going to tax you on $220,000 as opposed to the $200,000. So don't do that. It's not your money, and it's not anything you should be paying tax on.
No, your duty is to remit what you collect. Yeah, depending on the basis that you're filing under, and basis, whether it's cash or accrual basis, is another thing that you have to determine, and you have to decide depending on what jurisdiction you're in and their responsibilities. But the big thing is, don't inflate your sales number. It does not help you, okay? You should not include sales tax in that total sales number at all.
And that's in the instructions. Oh, and I know it's a lot of instructions. It's kind of a complicated area when you're looking at the code and you're looking at the rules, and that's across all jurisdictions. I don't think any jurisdiction is really, 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 really easy, because there's so many carve-outs, so many exceptions. But in the rules, they will tell you, hey, don't include sales tax in your sales figure. They're using that sales figure as the linchpin to figure out how much you owe.
Exactly.
And other than that, just knowing what your filing periods are. Are you monthly? Are you quarterly? Are you yearly? And because things are automated, understanding and realizing that just because your deadline is the 20th, depending on how much money you owe, you may not be able to file on the 20th. You may need to file on the 19th or the 18th, because it takes those systems a minute to generate, to do what it needs to do, to record the payment, to receive the payment. understand exactly when your stuff has to be in there and when it has to be processed in order for your filings to be considered timely.
Yes, the one rule of thumb I have when I file returns is I never file the day it's due. I always try to file at least a couple days before the actual due date, because you never know what wonky thing might be going on. And sometimes you run across systems where, say something is due on the 20th. If you try to make a payment on the 20th, they'll say it has not been received until the 21st. So you have that lag, like you just explained.
Mm-hmm.
So the best thing for you to do is to file just at least, at the bare minimum, a day early, because you want to be timely. And if you're not timely, there are penalties associated with that and fees associated with that. I think in Texas, the penalty for a late return,
I think
it's $50 at the bare minimum. It's $50. So nobody wants. I know, as an accountant, we may be dealing with the stereotype of me being cheap, but no one wants to pay $50 if you can just avoid that by filing a day early.
She's tight.
So just file a day early. I will admit to wanting my coin to go a long way. So file a day early. It just makes everything go a little bit simpler. And you also have the added incentive of getting the timely filer discount. And depending on how much money we're talking about, that can add up over time.
Like I said.
Tight.
And another thing too is that if you file on time and you're consistent about filing on time, if you are ever audited and you make a mistake somewhere, you can ask for a waiver or penalty. And one of the things they look at is, do you file your stuff on time? Are your returns on time? Do we get the money from you on time? We've had a couple of audits where an auditor will come back and say, well, we waived the penalty for these periods, but we did not waive them for these because they weren't on time.
Exactly. And penalty, as in Texas, is 10% of the audit deficiency. So depending on how big that audit deficiency is, that can add up. Coins again.
So just be a stickler about it. And the truth of the matter is, there really is no reason for you not to be ready to file this thing at least 4 or 5 days early. Because if you're a monthly filer, think about this. If you're a monthly filer, close should be over by the 10th or the 12th. The returns due on the 20th. When you finish close, I know you're tired because I've been through close a couple times. Just go ahead and file your return and just put a period to it and be done with it.
Yeah. Any other odds and ends you want to talk about?
No, that's it. Just, you have to be registered. Know what your taxpayer number is. Make sure you're hitting your deadlines. If you have a 0 return, file that sucker.
And don't include sales tax in your total sales number.
And that's the big one.
That's crazy. Don't do it. Yeah. Don't. Just back away. Don't do it. We have other odds and ends we're going to talk about in future videos, especially one of my favorite topics, audits. So we'll talk about that later. Thanks again for signing up, for clicking the video. I hope you signed up. For clicking the video. And if anyone has any questions, please reach out in the comment section. We'll get back to you. Have a great day and